Hey everyone, good afternoon. So we'll get started with the event. I'll request people seated at the back, please. I know you guys are comfortable here, but if you can occupy the chairs here, it will be great. Thank you. Come on, in the front. So you can occupy the back seats, but on the chairs, if you can. Okay, I see a couple of new faces. Rest of them, I know that they come here too often for the events. So how many of you want an introduction of Rise? Like would want to know what Rise is and cool. How did you get to know about this event? Okay, you got an invite from them? Cool. You? Okay. Meetup. So how many of you have have joined our meetup page? It's called Rise Open Innovation Program. Okay, cool. I'll just give a little introduction of Rise. Rise is a fintech-focused hub that we have here. It's a brand by Barclays. We just launched last year in June, and we have been in place for about 7 months now. We keep organizing a lot of these events, so Meetup, Facebook, like us on Facebook as well. That will be more active way of being engaged with us and knowing what's happening at this space. We have a fintech focused co-working space here, a beautiful space. If you haven't looked at it yet, just feel free to walk around once you're done with the event. And we have an accelerator program running here. Again, it's fintech focused accelerator program, wherein we have about 10, 11 startups who are part of the program, and they'll soon be having their demo day, I think in Feb itself. And third is the events that we keep organizing. So as I said, right, like us on Facebook, Rise Mumbai is the name of our Facebook page. Follow us on Twitter. It's at the rate Think Rise Mum. Meetup, you guys are already there. So be updated on all our events because we host a lot of these interesting events. I'll just quickly talk about this one upcoming event that we have. So we are hosting Swissnex India, who are coming in on Thursday, and we have a breakfast session scheduled with them, wherein we will be discussing fintech trends that you can look forward to in 2017. So in case any of you out here are fintech experts or fintech enthusiasts, you're most welcome to come in. Best part about all our events is mostly there is no registration or participation fee. So all you have to do is mark your RSVP online, not just mark going on Meetup, but also fill up the RSVP form so that we pre-register you here and you guys can simply come in and attend the event. Now I'll just hand over the mic to the Innovent team and they can get started.
Do we really need the mic? Hey, we're going to be popular. So, hi guys. Thank you for taking the time and to Harsh for putting this together, of course. Do you guys know who or what Innovent Capital is, or should I take the liberty of introducing ourselves? I see some familiar faces. Right. So, what we're here to talk about today is actually alternative financing for startups beyond equity. The idea essentially being to cover the landscape of debt, which is relevant to early stage companies. We get that a lot, that debt is not for us, it's counterintuitive, from lenders saying there's no way we're touching that segment. And Innovent Capital has been working at this since 2008 to bridge that gap essentially with what we call as venture debt. We'll get into more detail on that very quickly about me. So my name is Suhani, and I've been with the team since 2012. We used to be called SVB India Finance, in case that rings a bell. So that used to be the India arm of Silicon Valley Bank, a big California-based bank, uh, who are one of the pioneers of what we call as technology banking. What do we do with companies that have cash and cash flows but not profitability? What products can work for them? So we had a lot of that good legacy when we started in India. Till about 2015. That is when Temasek and United Overseas Bank came in and we rebranded to Innovent Capital. But we continue to do more of the same, which is make ourselves as entrenched in the startup ecosystem to provide them one with alternative financing and as much information as possible around that aspect. I'll let Vivek introduce himself and we can quickly go on to some more detail on this.
So thanks, sorry. So hi, thank you Zone, thank you Rise for having us here. So I'm Vivek. I'm also a senior associate at Innovan. I'm the latest joining out here. So Swani has been here all time, a really experienced debt professional over here. I've been here about 1 year. Prior to that, I was with PwC. I used to do financial services regulation work. So I used to do banking regulation, payment regulation, work with RBI, SEBI, those kind of entities. And I used to do a lot of lending type regulations. That was more of my focus. So that's how I got into fintech to start with, because I used to help early, credit fintechs kind of set up their products, talk to RBI, that kind of stuff. And from there, I eventually moved on to like, I want to do for credit, I want to do startups. Anyone made a lot of sense. So I'm kind of hoping to speak a little bit about, um, okay, so to backtrack, we've had our kind of years of big equity funding and the big stories and everything we have heard, and in the wake of that there's been a little more awareness created about debt. You've heard a little more about firms like ourselves, and there are other players in the market now like your lending cards and capital floats, and these guys have grown in the last 2 3 years as well. So there's some amount of capital out there which is not equity for startups, and I think there's not enough awareness about what it is, and how do you think about it, who the players are, and if you're a startup, how do you think about when should you take debt, when do I mix it, what are the kind of questions I should be prepared to answer. So I thought we'll cast some very high level light on some of these questions and kind of give you a picture of at least what we see out there in the market, right? So we'll break it up broadly into a little intro into how the way we look at debt, and kind of give you a structure as to how you should think about it, and then go into the kind of types broadly, which we categorize as what we do and what everyone else does. So we'll cover what everyone else does, and then we'll go into kind of what we do, right? If this can work. So one sec. Give me a minute, yeah. Okay. No?
So we've been working in finance for a while, so we know how interesting it can be. So please feel free to jump with questions as soon as you have them.
Yeah, I mean the aim is, it's the world in startups in general, and especially debt for startups is very fluid. So none of this is, it's not gyan or this thing is just mota mota hame kya dikhta hai wo bol rahe. So please do jump in with questions and stuff like that as you feel, and we'll try and chip in where we can. Yeah. So okay, we have a bit. So let's start on a bit of a dramatic note. Uh, some news, some big news that may not be as well published as some of the famous equity financings that happen. But we've seen a phenomenon. One of the most famous debt transactions that happened in startups was when Facebook took $100 million. It was one of the largest venture debt transactions in the world. And of course, the company that took it eventually went on to become one of the largest tech companies in the world as well. And since then, we have seen that the tech giants themselves have been adding, a huge amount of debt to their arsenal of already formidable equity. So more for a dramatic personality, but note being that it's big, it's become bigger, and it's out there, right? Correct. Uber has actually raised around $2 or $3 billion in debt in total. So it did one this year, it did one last year as well. At least as per media reports. We'll see what actually has happened. Airbnb is recent. Facebook, of course, took it out, and now is a listed company so as well. Other people like Tesla and all, of course, take it more routinely because they're a listed company, etc. But just to set a dramatic tone. So I'll just like to start off straight by going into the way that we look at debt. So debt varies from equity, obviously, and a little bit of structure is needed to think about, what's debt and what are the kinds of debt that exist out there. So the way at least we look at it is that there are three things that you can look at when you three things define debt, and where the what those three things. So the first thing is tenor, simple enough, short term versus long term capital. So the essential feature of debt is that it's capital that goes and comes back, unlike equity which sits and shares your risk, right? So do you have to repay over a shorter period of time, do you have to repay over a longer period of time, right? Security, which is debt is also typically secured. lenders take charge on assets or they take some kind of security. So it can be a spectrum from completely secured to completely unsecured and everything in between, which is, let's say, some stuff of yours I take, some stuff I don't. Depends, right? And the third thing is what I'm broadly calling compensation, by which we mean, how do we make returns? So equity guys, everyone knows how they make the returns. And there, in that context, you need to understand things like lick pref and anti-dilution and stuff like that if you're a founder. In the context of debt, you need to understand interest rates, fees that come up, kind of penalties that are associated with it, or even things like, even it can be compensation linked to equity. Some amount of convertible debt, or you can have, maybe warrant option kind of structures and so on and so forth. So there's a spectrum there as well, where we say there's a pure kind of debt instrument, which is only interest and fees. And then there's something which is completely equity style returns. And you can mix the kind of return you have depending on the situation you have to get something in between, right? So the specific combination that you may face of these three things is called the structure of the debt. And the most important thing to look at when you look at debt is the structure, right? Above, more than any single point, it's the overall structure of the thing. So if you look at cost and you think, oh, it's costly, but then you look at tenor and you say, okay, but how much capital do I have? What's the security I'm getting, etc. So you need to look at the overall thing as the important thing. One question that we get a lot, which I just like to clarify: convertible debentures is not debt, right? So the stuff that you see in angel rounds, where very often, or kind of seed rounds and all, where somebody puts in a convertible debenture to fund you, which necessarily converts at your next round of equity, that is not debt, because there's no meaningful compensation or structure to it. It's essentially a way of getting you money quickly without having to set a valuation expectation, right? So typically those contracts come with a next round, we'll decide your valuation, but take money now. So just to clear that one thing, because you've heard that a fair bit, right? So we're going to talk about proper vanilla debt, right, rather than that. So I'm just going to cover some like broad products that are maybe applicable to startups as a whole in the debt kind of universe. So debt, like we just, in the framework that we spoke about, you have short-term debt and then you have long-term debt. And we're saying that the broad two purposes for which you can take it for any kind of debt is generally optimization, right? You want to optimize on your cash flow. If you buy an TV or something and use an EMI, what you're essentially doing is that, okay, I could get this money, but in the future, so I'll purchase it today and pay it out of my future cash flow. So you're optimizing more often than not on it. And in the case of companies, well, you also have a chance to grow with that company. So it can be capital as well. So those are the two broad extremes of, the purposes to which debt can go. And so in that spectrum, we see that the first, and we'll come to what these particular things are, and many of you all may be familiar with what they are, but we'll just come. So there's some certain facilities like working capital, short-term financing. And on the very end of the spectrum is kind of what we do, term debt, which is, long-term growth capital kind of debt. And in between you have stuff like leasing and mezzanine. And mezzanine is a fancy word for the fanciest debt that you can find, right? So it's debt which is very mixed with debt and equity, and the compensation is structured. So it has very high structure basically, and it's very very purpose built generally. So you have very specific purposes for which you want very very specific structures, and that's kind of what. So we won't cover mezzanine so much because it's more of a private equity large company kind of thing. It can happen in startups, but not very relevant for young startups at least, right? So the main two things are short-term kind of solutions and long-term debt, and those are the ones that we'll largely cover. So let's just high level understand that traditionally, so equity investors look at you and they look at, okay, what's your market size? What's the team like? How's growth been? What's the potential to capture the market? What's competition like? And that's how they kind of assess your, let's say, enterprise value, right? That's how you get your valuations. That's how you get your equity fund raises. So in credit, similarly, at least there's a traditional way of, so in the VC perspective, if you look at the private equity ways they work the firm, they look at cash flow, right? They look at cash flow of the firm, free cash flow, how much is the cash flow growing, and they value it. And you can't really do that with startups, so you do the VC way, which is to say that I look at enterprise value, market growth, etc. Similarly, in debt, you have a traditional way of doing debt, which is to say that the most basic form, you have assets. These assets are illiquid. So you have a house, you have stocks, you have some kind of gold, something like that sitting with you. It's valuable, but it's not liquid cash. You need liquid cash. So you can pledge that asset to somebody and they'll give you money against it. Most vanilla form of lending ever, And in Indian banking context, almost 80-90% of Indian banking is asset-backed lending. So mortgages, shares, whatever they are, right? That's the first thing. Second thing can be profits. So if you're a company that throws up cash, that throws up profit, uh, you can then finance against the profit, right? You making money, so I can give you money against that. And that's, to take a retail example, if you're a salaried individual, you get a predictable salary coming in, I can lend against that salary, right? Let's say you don't have profits also, you're a non-profitable company. I can still maybe lend to you flow, because what can happen is that you get sudden surges of liquidity and then you drop. So on a accounting basis, you may not be profitable, but you're actually getting certain amounts of liquid cash at points of time. So if I can trap those flows, a lender can still give you money. And that's kind of the pretext of people like microfinance firms or your like really micro SME lending kind of guys. That's kind of what they kind of trying to tap in. So I can form structures that tap just cash flow basically. And if you have none of this, I go to the person whose business it is or the person itself, which is saying that if Reliance has started a new company which is making no money, I will still give it money because it's Reliance, right? So I can do that. For startups, unfortunately, generally none of this exists. No assets, definitely no profits. Cash flow is weak, or there's no sufficient liquidity there. And promoters are generally new, or even if they're professional and such like, they're not old enough or they don't have substantial net worth of their own. So in this case, how do you underwrite, right? And that's kind of our job to say that, okay, what's our model? How do we look at underwriting startups? So I just like to cover one thing before Swani covers the way we look at underwriting in terms of debt. So the kind of questions you necessarily want to ask long-term lenders is different from the kind of questions that short-term lenders will ask you. So I'll just cover short-term lending broadly. So so what kind of startups are out here? Like, what do you guys do? Just to get a sense of how many are B2B kind of guys? Like, okay. And so what's your B2B? Okay, and your clients are okay, okay, okay. And yourself? Okay, so banks are your clients. Okay, okay, great. And B2C guys, and how many B2C guys out here as well? So what's your B2C? Okay, okay. So you provide electricity solution. Got it, got it, got it. Actually, that's perfect. I'll come to that why. Yes, sir. E-commerce. Okay, but inventory, non-inventory, aggregator, inventory. Okay, so good. So I mean, you know, good examples here, fortunately. So there's slight difference in terms of, so if you're B2B, B2C, I mean, you'll have seen your own cash flows, right? In your case, it would be receivables to corporates and the market research firm, bank receivables, which may stretch to, you put out a contract. It varies from company to company. So let's say you're a software service provider. If your clients are very small, you go and it's quick to sell to them, but the money may take 30, 60 days to come back. And you're kind of crunched in that time to actually fund your expenses, operating expenses, right? If you're, let's say, software as a service, SaaS kind of people, and you target, let's say banks, for example, or you target US clients, it may take you 6-8 months to actually sell a contract, in which time you have to make a set of expenses to run a pilot test, prove your kind of product to them, and then they actually give you a contract and you start getting revenues, right? Or in the case of if you and in the case of B2C, for example, if you have a device or something that you manufacture or your inventory business, you have a certain cycle in which generally B2C businesses don't have short-term capital issues because customers pay you upfront and you get that money, but depends on what you're selling them, right? So if you're selling them from inventory, then you are purchasing that inventory upfront and then you're deploying it. So if your demand, something goes off, you're out of cash for a bit. And similarly with the device, right? You put in capex, it takes you a while to put it out. So there are lots of needs of different, and I bucket there are many products under these broad headings. And I'm happy to take questions about whatever of them I know. But the broad idea there is that, okay, the third thing is probably leasing, and I'll just come to that maybe in terms of assets. So most startups, most of your short-term lenders in the market, your lending cards and capital flows and stuff like that, what is important to them, right? Now, given that you're startups, you do need a certain amount of starting liquidity for lenders to be comfortable with you. Preferably, a couple of months or something, some liquidity, funding, etc. If you've raised some amount of money, it helps, right? But more primarily than that, it's the quality of the revenue that you earn, right? So if you're a B2B company and you're selling to banks, for example, that's a very high quality receivable generally. A bank is generally a very trusted, regulated entity with a lot of capital and stuff like that. So the probability that a bank will not pay you on your receivable is kind of low. Whereas if you're, let's say, servicing SMEs, that can be a much more challenging thing because nobody knows the SME. They may default, they may run away. How long have they been your client? These all become challenges, right? So quality of revenues is the main thing. If you're a B2C company, then you want a little bit more predictability in terms of like, okay, you deploy inventory, right? So if you have like a, let's say 6 8 months or a year's worth of track record of saying that I deploy this inventory, my flows are predictable, they're every month they happen, I get this, it helps your case in that sense. Or let's take a little more new age case. I don't know, are there any rental kind of startups here, guys who do rentals, like for Lenko, Rentomojo type guys? Nobody? So in those models, it's more interesting because they actually rent an asset to a customer, right? And then they are actually dependent on the customer's credit worthiness to pay them back those rentals. So those companies, if they avail debt, they need to actually prove that their customers are actually credit-worthy customers. So they may want to provide CIBIL records, etc., of their customers, which depends. So key things: quality of revenues, predictability of business, security structure also matters. So in the case of, this is more a B2B issue than a B2C problem because you can have different kinds of requirement, like you raise an invoice, right? And the invoice gets settled. That is a better thing than, let's say, a purchase order, right? So there may be people, and then that is still better than, let's say, pre-shipment. So you get different types of, you want inventory, right? Typically you can finance working capital after you've sold your inventory, or you can finance it before you've sold your inventory, and that makes a difference to the lender in terms of that. So you need to be prepared to answer very granular questions on your operational flows, like exactly how your money comes in, money moves out, how your invoicing process works, when bills are raised, and when money actually comes in, right? So that detail is necessary for a lender to understand what kind of risk he's exactly taking, and therefore recommend a structure to you, some kind of security structure to you, right? If it is secured, and secured is cheaper, there may be guys who are willing to give it to you unsecured as well, right? And then the last thing being enforceability, and this is more a thing, let's say assets, right? So let's say you have hard assets which you want to maybe lease. So you get a manufacturer to manufacture your assets, but you want to lease it out from them and then deploy it further to your people. So that's more efficient for you from a cash perspective. You don't put out a lot of cash, you're putting out as much as you need. But the challenge can be there for the lesser kind of guy, that can I actually get that asset back, right? So sometimes if I go to an SME and I give him a machine that allows him to produce, let's say, textiles, I know that if I take the machine away, he can't do his business. Therefore, it's imperative to him that he pays me. On the other hand, if I deploy, like, let's say, furniture at somebody's house, or let's say, I deploy a hospital bed at a hospital, it's very difficult to take that asset out. You can't actually kick somebody out of a hospital bed and take that thing back. So if you give that, you're running a very high risk. So you might find that people are not so willing to fund that unless they themselves have some particular understanding of healthcare that, so maybe Piramal Group is very happy to do it because they understand healthcare and they have a lot of presence there. So they can actually enforce it, right? And also the general liquidity of that asset. So if your asset is a, let's say, a textile machine, there are lots of other SMEs I can sell that textile machine to. But if it's a specialized asset, which is only for me, your lender cannot necessarily repossess and sell that asset elsewhere. So these things matter. So you need to be prepared to answer a lot of like detailed questions on how your money flows, what's the asset like, etc. and stuff, right? Um, I think, yeah. So I think from your perspective, what's important is that these facilities, see, all lenders will come and they'll sell our product, right? We'll sell our product. For you, it's important to actually note down all the potential costs that could be there to you of taking this facility because you're optimizing. And you need to probably do a detailed kind of modeling of your own cash flows and see what the real cost is to you in an IRR term. So you model out your cash flows and look at that, and then see the true cost of it, because there'll typically be things like fees and there'll be interest, and you have to also look at scenarios. So even from a short-term working facility point of view, it can turn out to be quite expensive. You're not paying attention to exactly what they're kind of pitching to you, and it needs to be tailored for most startups. It's not one-to-one copy paste from a corporate to a startup kind of setting, right? So I'm happy to answer any questions on. So we do some amount of syndication for our startups. So we do our term financiers, but we also syndicate from our banking partners a lot of short-term solutions. So we work with NBFCs, we work with banks, guys like IndusInd and RBL Bank and Tata Capital, to get some of these solutions for startups, which we ourselves don't provide. And we support this transaction by advising the startup on, look, We negotiate for them, we help them go through the docs, etc. And for the lender, we help them understand the company, and we also provide certain credit comforts in this thing. So, happy to answer any questions on this if you have. Fund? Less than a year typically. So anything can like 2 months to 8 months kind of thing. Generally, it depends. So discounting, for example, will be 90, 120 days because most invoices have a very specific life cycle. Like they are not generally, it's very hard to find an invoice cycle which is more than 120. Working capital, on the other hand, may be more structured, right? Certain businesses have very quick turnover of inventory. So there 2-3 months is fine. And it'll be a line. So you get a facility, you can draw on the line. Some things maybe even 6-month working capital facility, depending on. So if you're very, you're a infrastructure kind of company which is deploying big machines, takes you a while to get that money back. So depends, but less than 1 year is generally the idea. Yeah. So it's not okay. Theoretically, not necessary, but depends on who you want to borrow from, right? So the absence, if you want to borrow from banks, collateral is almost 100% necessary, right? And even the nature of collateral matters. So we've seen, so for example, even people like Flipkart have raised money from, let's say, HDFC. What the paper doesn't tell you is that facility is some 500 crores or something like that, right? It's backed by some 600 crores of cash. So they've put 600 crores with HDFC and they're drawing short-term working capital line against that, right? So the banks will almost always need collateral and almost always need cash collateral, right? Unless you have property and things like that. In specific cases, see, in product like discounting, you're automatically secured because there's an invoice which is there. They may take security on top of that as well. So it depends. On the other hand, some NBFC lenders, which are like, and there's a range of them. There you have your traditional NBFCs, your IIFLs and Aditya Birla Group and all that. And then you have your new age NBFCs, which you're lending card capital float. They may not insist on security, but depends, right? So it's a working capital line, right? No, so the point is that if you're out of money, what happens, right? If you look at, so in all debt things, if things go well, great, right? You don't need anything. But the point is you have risk in your business. So I want to be able to have cash. So in case things go wrong, what do I do, right? So I want to be able to draw, let's say on a perpetual basis, some amount. So that's generally the rationale for working capital, that I want my money to earn something, but I don't want it out of my pocket. Because if let's say I use my equity, right? Then that money is gone. It doesn't earn me anything. And the next time I have a working capital crunch and something goes wrong, I'm screwed. In this one, I have a line. So I earn something, the cost is therefore minimalized. And anytime there is a problem, I therefore have my cash to save me anyway. Right? So that's kind of the idea. There's an interest rate arbitrage as well. Yeah. We are an NBFC. So in India, we are an NBFC. We lend. So we do term lending, right? For our, we put our own money to work. So Temasek has given us $200 million to like put into Indian startups, which we have put into several companies, which Swani will cover. But for those companies that we fund with term debt, see, our presence also makes a difference to banks. You bring any startup, see, what's the difference that an equity investor brings to you? Credibility, visibility, some validation of your model and things like that, right? Similarly, for lenders, for banks, our presence makes a difference. Saying that, okay, these guys are there, they're managing cash flows, they'll manage it for us. And that's kind of where we come in. So we do it only for our companies. We don't do it wholesale on that part. Yeah. Yeah. So I'll leave that part. I'll leave that part to. Yeah, I think we'll cover that in Swani's piece. But no, we have our own diligence and stuff like that, and happy to answer questions. It's not that okay. You can't underwrite to it. So I'm saying that if you see, if I bring you a company which is throwing up 10, yeah, we cannot underwrite to. Correct. But it's important at the same time. So for example, I'm saying if I bring you a company which throws up 100 crores in free cash every year, you can lend to it, and you can look at the financials if you want, and you will, of course, as part of process. But what do I do if I bring you a company like which is burning 100 crores a year, but is worth $5 billion and has got a great investor set? How do I look at it, right? I need to look at the financials. I need to understand where the company is burning money. Are you, where's your, do you have any incoming cash? What's the nature of that cash? So we look at it in quite some detail to understand exactly what's going on in the company. But the fact that it is burning cash does not bother us because everything sees us. So it's not that we discard it. We need to understand. So if you burn cash because you paid for marketing and you overpaid 10 times what everyone else paid, very bad. But if you paid it to invest in growth and you're growing, great, right? So we need to understand that piece. That's all. So I think with that, oh, sorry. Hey, hi. Meet again. Huh. Yeah. So we don't do short term. So we don't do short term, right? So we don't do that. No, no, we don't do this. There are other people who do this, and we get it for our startups from banks, right? We've done some 6 or 7 transactions in this space alone, so it's a new product for us as well. It's been very tailored to. So we have done 2 operating lease, 1 discounting, and I think 1 working capital and 1 bank guarantee transaction, which is different. But it depends on the startup circle. But most of them are 3 to 6 month kind of things. Like I think, yeah, that will be better. Cause so I'll leave this to Sarah.
Always get back to questions.
Oh, so no, no. So most of these facilities, by the way, will be they'll give you something called a APR, right? Annual cost of it. But the way the lender thinks of it is on a monthly or a depending on your repayment, right? So the lender is looking at a short-term IRR and then annualizes it. Even the annualizes it only because that's the standard they're showing. Like a mutual fund show you any complicated. Right? So for you, discretize it to that period and look at the IRR that you're making. That's what I mean by it. Not necessarily an annual IRR like a VC fund is looking for a 12. Yeah, no, not just to understand what exactly you're paying for. Right? They can
So,
be.
I mean, layman terms, what could you look at is if you count a 45-day invoice, what exactly is the benefit of getting the cash upfront? You think the numbers make sense of paying a certain X percentage interest to get that money upfront? You should probably be earning something with that. You don't require it to make money on money, but the math has to make sense. Otherwise, you don't really need working capital. So why are you bearing that? So how many of you have raised funding for your startup, are looking to raise funding, just to get a sense? These are have raised? How many have raised? And how many are looking for their first angel seed checks, I would assume? Anybody who's ever thought about debt as an option of financing upfront? How has the experience been? How many were able to raise some debt? Was it largely to institutions like SIDBI or government institutions? Through SIDBI, right? You've you've raised debt, right? You mentioned. Yeah. Oh, so large companies basically for your portfolio. Okay, got it. Right. And those companies, I'm assuming, are funded companies or smaller SME companies? Oh, no, private equity backed companies you mentioned. Got it. Cool. To quickly jump into what we call as venture debt and moving on to what Innovent does exactly. Right. I know that by heart by now. So venture debt is essentially funding, be it long-term or short-term, depending on usage, for companies that have some sort of venture capitalist backing them. Why the VC becomes most important to the relationship, you'll find out soon. But let's look at the segment we're trying to fund, right? We're trying to fund companies that are just off the ground, are in a segment that nobody's sure works or not. I mean, I still hear skeptics saying, I don't think e-commerce works in India, or Ola is not going to last. I mean, we kind of hear these conversations happening around us, even now when so much money has gone in. So we're looking at a segment that we don't really know is here to stay for sure. These companies usually don't have any profits or are struggling to make profits or have spikes in slowdowns. And revenue is tricky, regulation is tricky. Basically, it's a really volatile environment. What we or any venture debt provider sees as an anchor in that relationship is actually the VC, because we believe that if there is an investor who's putting serious money to work, there is a very long drawn thesis that goes into it, and they have certain vision for the company, and that vision is generally demonstrated by how much money they put at stake, right? So that's what we try and underwrite to most in terms of what our pillar of underwriting is. It becomes the VC in the relationship and how much money has gone into work, and then we get into the success of the business and the plans and burn path and runway and things like that. So this is just a very quick visual of what a startup goes through, right? So you raise some funding, your series A, B, C, and essentially the cash drops at certain points as well. And in the meanwhile, you're growing steadily. But what do you do when you're here? What we've seen in our portfolio is that either your growth gets tampered or you're running so fast that you might be around a cliff where it becomes tricky and you're sort of reacting to what the situation is. Either you're able to raise money but at poorer terms that you would have otherwise raised, or you have to quickly come to a halt. Uh, what is the best mode of planning, and that's what a lot of startups do go through, is actually start planning your fundraise much ahead in time, and that time period is essentially what we call runway. So at this stage, I would say that this company has an X amount of months to go, and that's when we start thinking about, okay, what is the company thinking about in terms of funding, growth plans, and burn plans. What we think are drivers of startup credit worthiness for venture debt, like I mentioned, investor set, top top notch. Uh, we frequently say in office that not all money is the same color. So it does make a difference to us when that money comes from HNIs, angel investors, and individuals, and when it comes from institutional VC investors. And the background to that is that when an HNI is putting money to work, I mean, we've all seen startup fundraisers go. There are cases where we've seen checks pulled out at the last minute, someone getting jittery because a regulation changed, someone said something and that kind of made them rethink about what their thesis is. And why does that happen? Because one, these investors might not be the most savvy people in that sector, and two, it's personal money that is usually hard earned, and they think that much more when they're putting that in a company. So that does not seem very reliable, right? I mean, even as startups or as someone who's underwriting to that, what we instead believe is much more reliable is when a VC investor, an institutional investor, is putting something to work. Um, these funds are raised. So we'll be very surprised if a fund itself vanishes out of India, or there is ongoing activity, there is portfolio management and general partners hunting deals, looking at deals. So there is much more method to madness in the way they deploy, which is that much more credible. Next, of course, becomes equity raised and liquidity. And what that signals is growing validation of the business model, essentially. Let's ignore the boom of 2015, where we all saw lots of startups raise money that didn't make sense to a lot of us, right? Checks that seemed really bloated for segments that weren't established for sure. Uh, we saw dozens of startups in hyperlocal segment getting funded when we didn't even know if the economics make sense. And so many such other booms we see in certain sectors without knowing whether it'll have a future or not. So equity raised makes a difference, but as lenders, we, like Vivek was alluding to it earlier, we'll always think of what the downside is. So if it's a company that's in logistics or pharmaceuticals or has a manufacturing plant and is into building brands, that's a far more understood business. I think we can all imagine that, okay, these businesses will work because one, either the market is already created, or it is much easier to create that market for customers to adopt or businesses to bite into that. But underwriting to the predictability of something that's extremely new age, like AR, VR, bots, I mean, these buzzwords that we hear all around, we don't really know what is the application yet. So that makes that kind of that's got to be read together with equity raised. So it doesn't really help if a new startup completely off the ground and something extremely unconventional has raised $10 million. As a lender, we still wouldn't know what is the future of that $10 million or that company in that segment. So we look at that very closely. Burn and cash flow, of course, because that has a clear relation to what the runway of the company would be. The one thing that as venture debt providers, we've been extremely disciplined about, and that's done as well, is that we don't do bridge situations. Bridge rounds are essentially when you have less than 6 to 4 months of runway, and you're looking at financing your path right till when you raise the next round of equity. That's something we consider as equity risk. We're not paid to get those returns, nor do we understand those situations where management is fighting every day to keep the lights on, and investors are worried whether they'll have to put in more money to work or get up some of their partners to underwrite to this company, etc. That is considered a bridge situation. It gets one level better if, say, you're already in the funding process and it's just a matter of time that your regulatory approvals will come through or the funding will come through. But bridge situations is something we stay away from, also because of the sake of the company. You don't want a nervous lender on your back when you're looking at last 4 months of your runway, because the lender has the power to take your company down. With an investor, you can still take the liberty to think that, a person has invested like 30-40% or owns 30-40% in that company. It's partly their company as well. So there's no joy in running it to the ground. They're not going to get anything out of it. As lenders, upside is great, but that's not our business. We just want to ensure that our principal is protected. And that's the difference between venture capital and venture debt, right? VC knows that half of its portfolio is going to burn and is okay taking that kind of risk because the two companies in their portfolio are going to return the fund. With us, we give out 100 loans, we want those 100 loans back, and we want some money on top of that, which is essentially our returns. So we will definitely stay out of any scenario that has a larger possibility of going to the ground, and a bridge situation is a very simple example of that. Yeah, and I mean, that's something, like I said, that discipline has only done us good. We quite immodestly sometimes say that our best brand ambassadors are companies that have faced stress, because it's important to know how did the lender behave at that point. Sorry, you had a question? Uh, right. So these three components plus what is your core business, what is the model, of course it helps if you're selling to enterprises, because we know that a bank will behave or a Microsoft will behave. Some of those flavor put together is essentially what we call as enterprise value and business value, right? So the question to answer in that $5 billion example that he was giving, who may have raised 100 crore of debt, is if the company goes down, will this company be worth 100 crore? I mean, I think we believe that some of our unicorns will be. So that's the leap of faith that some of these lenders are taking, that if things go sideways, will someone purchase this company for at least this much? And being senior secured lenders, you typically come above everybody else. And that's the underwriting that any lender will look at. Basically, protect downside and what happens when things go sideways. That's the line of questioning. We don't really care if you go grow 100x month on month, or you onboard the most marquee clients in the space. It's good for you because it's helping your business, and essentially what each success is doing is increasing the probability that you will raise the next round. And that's all as venture debt providers we will see. Because I mean, okay, if this is a VC and if this is a debt provider, if this is your regular bank, we usually say that Innoven is somewhere here, or venture debt as a category is somewhere here, because while we have the potential to liquidate a company or recover our money, is it really possible in a place like India where contract isn't very strong? We don't have good contract laws. Or second, these companies don't have IP that's registered in a way that can be liquidated. And there are definitely no hard assets. I mean, there's only so much you'll get out of taking all the laptops away, which is mostly what these tech companies have. So the reason why the risk profile is closer to VC and why we liken ourselves more to venture capital than to regular lenders is because if you don't raise that next round of capital, we'll all be in a pool. So that's why we are interested in knowing if you will be a successful business model, if you will attract investors. Given our relationships in the VC world as well, given we only work in this space, there are several times where we've endorsed particular startups for the value we see and the match that we can potentially make to a venture capitalist, because we know what they're looking for and we know this company is good to put that check in. But should some of those things start waning off, that becomes a problem, because if you don't raise that round, we'll all be screwed. Yeah. So, so it is right. So the business model does not worry us. Sorry, a couple of questions here. Business model is fine, even if it's a company that is attempting something really bold and daring and unheard of. That's great, because it might raise that next round of capital, like I said, right? So fintech, for example, last 12 months, we've heard fintech all around. And is it a space that is promising? Definitely. But more importantly, is this a space that is seeing a lot of investor interest and will continue to do so for a while? Likely. So that space becomes interesting for us. On your second point, that is it a hard and fast rule to go along with VC investors? Kind of. So we venture debt essentially is debt provided for good companies in a VC portfolio to become much better. And in that respect, we only co-invest in certain situations. The only time we're okay to make exceptions is when the companies are sizable enough. The business has its own legs, and there are predictable cash flows or profitability, which brings it closer to an area which would be conventionally lendable. But say if it's an acquisition finance, that's something that banks don't have the credit appetite for usually, or if it's cross-border finance or certain mezzanine situations, that's where you see NBFCs being a lot more active. Or say a business model, like, I mean, we've done a couple of, like one of the companies in our portfolio is an ad tech company, advertising technology. It is profitable, it is sizable, but banks don't understand that space and they usually won't lend to that space. So in those areas, again, that becomes an opportunity for us to put something to work. Sizable cash flows, say uh, about 50 odd crore or more of revenues and about certain percentage of EBITDA on top of that. So, no, I'm sorry if you've written to the website and nobody has responded, but I was saying I'm sorry if you've written to the website originally and nobody has responded yet. But so what do we do with the, let me talk about that. So evolution of how we've come to be, right? We started only with looking at companies that were post Series A because Series A is too risky. It's the first check. When we were new to the market, we didn't really know if a Sequoia or an Axel or a Norvest is going to follow on. Those relationships were new to us. Just giving some examples. So B's, C's, D's, easier. Uh, what happened next is our understanding of the market got much better. So this whole unsponsored, as we call it, companies that do not have a VC sponsor behind them, but has, say, sizability, like I was mentioning, that has been evolution for us. So last 12 months is when we've actively started looking at that segment, which we call the growth segment. There's also been learnings on the early stage segment. So pre-series A. What can be done there for that segment? And does any of that help for them to become a good venture debt candidate at some point? So what we try and look for in a bootstrap company, seed funded company, angel funded company, of course, getting to know the business model better and all of that helps. One thing which we can help with and do very actively help with is if it's a bootstrap company looking for investment, you still fall in the category that will at some point go through the life cycle of being a VC funded company. So if we can find you early and if we think that our network of angel investors, seed investors, VCs could be the right people for you to speak with or our portfolio. So one thing is helping you get investment. The other thing is, and that's something that we strongly believe, that it's good to get you funding, but it's even better to get you a customer because that helps your business grow. And our portfolio is now more than 60 active clients. We've done about 140 loans in total. So if you think that one of these companies could be relevant, even if you're bootstrapped, but we believe that the product is strong and someone in the team has spent time understanding that and is able to endorse that, we're more than happy to bridge those gaps and make those connections as and when we like. This is of course softer. I mean, it's just things that we do to make ourselves useful in the ecosystem, but we still think it helps some of these companies. But can we put money to work? Can we actually provide venture debt at that stage? Very tough. The only part where we can help is actually we work very closely with SIDBI. You mentioned you've interacted with them. So SIDBI, the whole CGT MSE scheme that they anchor. So we know the team there, and in the past we have taken several proposals to them to try and see, to try and get a sense of what sort of companies are they interested in, because it is a huge pool. It is not most well managed, I would say, because we don't hear of that many startups benefiting from the scheme. I mean, at least I don't. So the idea is that if we can reposition it in a way that makes more sense to SIDBI, given that we only look at companies from this lens mostly, that's something we're more than happy to do again. Um, So very quickly, a representation of what we've all been talking about, right? So venture debt can be used to fund growth. Obviously, if you have $5 million in the bank right now, can you do something more with $1 million? Only if you have that kind of hunger and your business model can absorb more capital is where more capital makes sense. So funding growth is the most common use that we see. Our loans are general corporate purpose. Our clients are free to use the debt as in how they please. That's one. Second is extends cash runway. So actually, the first to put together, the way we call it is venture debt can either be a booster, so you do much more with that capital, where in the same time frame, say in the 12 months, you're able to demonstrate one more new location, one more new office, one more new product, one experiment, one pilot, one key hire that otherwise wouldn't have been possible. So those are all things that signify growth or potential for growth. The other way venture debt can be used is as insurance. So what happens when things don't always go to plan? You've planned for 12 to 18 months and you've raised your equity, but suddenly in month 3, something's looking off. Your co-founder has left or your product is not looking in shape and you have to orchestrate a pivot. So what do you do in that case? The most valuable thing anybody could give you was time, because cash will run out and you need to buy time essentially. So you do that by either, of course, optimizing your own burn or having the benefit of having raised some more money for the same amount of dilution, because every startup goes to say a 25 to 35% dilution at their Series A. But if you're able to buy more time for that amount of dilution, that could be worth its weight in gold. Minimize equity dilution, straightforward. So you dilute 25% in a round by maybe raising $5 million. Could you raise $4 million in equity and $1 million in debt? That's 5% saving right there. Or say you've raised $5 million in equity already, have diluted 25%. What if you top that up with $1 million of debt? That's $6 million for a dilution worth $5 million. So that helps you optimize this. And the last and softer aspect of debt right from your early stages is the credit worthiness it brings. So very often companies as well as investors actually like this product is because suddenly this business, especially say fintech businesses that need to show a clean track record, or companies that have a very high volume of business going through them, high throughput, and need working capital. Uh, Equity investors won't like to fund your working capital because that's not the best use of highly expensive money. That should essentially be funded through debt capital, which comes at a reasonable cost. So some of those things establish what we call as credit worthiness and credit track record, so that when you are eligible to move on to conventional bank financing, the person has some more confidence because you have serviced debt in the past with a clean track record. So that's another softer aspect of having debt. Cheaper than equity financing. So of course, the cost of equity could be varying, right? I mean, depends on what your company has commanded in terms of valuation and how much you've diluted and what is the purpose of that. In terms of debt, our typical return expectation is somewhere around 20% average. Uh, would cost of capital in terms of equity be slightly more than 20% every single time? We're all, I mean, the idea is to build a company that's much more valuable than that, where your 25% dilution is worth much more in terms of is worth much more. That debt cost fades away in front of that.
Kind of return that they expect on their capital versus what the debt fund are expecting. From your perspective, the thing is that what is your equity? Everyone goes into this game assuming that your company value. If it isn't, then why are we? And so maybe it's a good time so to cover a bit of product structure broadly. So that gives a sense of how this, even though we say 20% IRR return, our debt is not straightforward debt. It doesn't mean a 20%.
Yeah, that's an important clarification. So, so quickly on our structure per se, we do everywhere from a couple of crores in debt as first check to all the way about 50 odd crores very selectively for a few companies that would be eligible for a size like that. Uh, what it translates to is roughly 10 to 20% of a round size. So at a series A, B level where it's tough to establish exactly what the business is worth, we'll try and do a function of how much equity you've raised, because at least you'll be worth that much, simply put. So that's on the amount that we play with, at least initially. When I said we've done 140 loans, it's actually to 90 companies, which means a third of our portfolio or more than that has taken capital one more time, because the logic of not diluting or extending runway works with every single round that you raise. So so that also allows us to do much more with a company across 2-3 loans or across different life cycle of the company itself. The commercial structure, it has a coupon, of course. It's a term loan, so we're a rupee NBFC in India. We fund in INR, and the repayments are monthly. It's not a home loan structure where EMI is fully loaded with your interest cost. What we do is essentially charge interest on a reducing balance, which works out slightly better than the first option. So there's an interest rate which is roughly between 14.75, 15 odd percent, 15.5%, depending on the mood of the environment and also what the company commands. It's still very commensurate with where SME lending is right now, in our view. There is some other processing fee, etc., which totally adds up to about fixed returns of 16.5%. The remaining comes in the form of an option. So this option works very similar to a warrant structure, if you're familiar, or similar to an ESOP structure as well, where we have the right to subscribe to a certain amount of shares of the company. That amount is dictated by the loan amount itself and the valuation of the company at the time we went in. So a Series A or a Series B deal versus a Series D deal would mean different percentage points on the cap table itself. So the idea of that instrument is it's a 7 to 8 year instrument where we will subscribe to shares only where they're worth something. The idea is to make the differential for the risk that we taken several years ago. So at year 8, if your company is going through an acquisition or an IPO where there is a liquidity event and every investor and the founder on the table are making their returns at that point we like to monetize this instrument as well. In India, so far, we've monetized this 4 times, popularly, say, with the free charge transaction or with the Mintra transaction when it got bought out by Flipkart. So the philosophy is that some of these hits, these will not be the proportion of VC hits, but some of these hits allow us to take risk for the rest of the portfolio, where we at least want to make slightly elevated returns and also cover up for some cases where the businesses might not be able to return the capital itself. So that's a risk that we mitigate by some of these supernormal returns that we make on certain companies. No. So it's a fixed rate loan. I mean, it's just that, well, you have the benefit of getting a fixed rate loan at this point when we believe that the onus on the company should be at a certain level. And all we're trying to do is back end our returns to a point when the company can support that. Now, if you're, sorry, in a scenario where the liquidity event itself does not happen, our option lapses, if the liquidity event happens in a manner where there isn't that much gain to be made, we might not exercise that option. So all the debt has cost you at that point is your fixed return. But we don't go back in time and change. So
So essentially, the kind of way we look at our loans, right? So I mentioned our underwriting factors, and nowhere do we rely on assets or personal net worth of the promoter and stuff like that. We do take charge on assets, but that's more legal protection for us. Generally, there isn't anything that is worth lending to. So our underwriting in that sense or our decisions are not made on that basis. So essentially, the loan is unsecured in that sense. And if you had to get such an unsecured loan from the market, your interest rates would be upwards of 18-20% easily, right? So that's one cost on that benchmark, right? The second thing is like so we think that 14.75 or 15% is therefore on the much lower end of that spectrum as well. And it moves with the interest rate cycle because we are leveraged ourselves. So if interest rates fall, these rates could fall as well, right? The other thing is like from our investors' perspective, right? Now, if you are an investor in a debt firm like ourselves, why go through all this trouble to get 15% interest, right? When you could go to the stock market and get a 12% or 13% coupon BBB minus kind of instrument of some Thermax or something like that, that's much more liquid, that's easier to get, and why go through all the trouble? So that's where the optionality instrument comes in, because the way you'll obviously know how VC firms work, right? They concentrate their investments, they have that one company which gives them the entire fund, and that's how they make money. For us, it's kind of the opposite. We are able to spread bets across VC company portfolios, so we have a much larger portfolio than typically than most VCs, and we have small equity stakes in many of them in the forms of this optional instrument. So on a portfolio level, one, two of them kick off, then our company as a whole returns this 20% IRR, which is great for debt. So that justifies it from our investors' perspective, so to speak, and that's why the product is priced the way it does. And it kind of doesn't work if that's not there, because otherwise, if you were an investor, you would say, "I'll just buy something on the market," right? So that's kind of the logic. We fund across sectors, so no sectoral preference as such. We have certain sectors we understand better, but as of for financing, we look at everything. So no nothing. Not traditional stuff like textile and like core traditional stuff, no, but mostly.
that does raise VC funding for
Yeah, that could potentially matter. Many. I mean, look right here, capillary tech, uh, capillary. We've recently done Unbox. We've done Manthan, Moving Singh, Germinate. About our portfolio is 50-50 between B2B and B2C. All roughly 50-50. Roughly 50-50. Must be more like 46-54, something like that. So we do that. That's a segment we like as well. Done a lot of big companies. Fun? Yeah. The bottom half is gone, unfortunately. But I'll tell you what's there. Suburban, Topper, Entomojo.
So it's a good case study in a company that didn't really pan out as expected, but had certain things going for them. And by certain things, I mean it had management that was far more, how do I put it? They had the vision that they were, you know, in a journey that required much more capital than they were willing to manage to build this business, or in a space that was seeing competition or economics not pan out, at least that they had envisaged. So they took a very conscious, proactive call to not pursue that line of business. The business was always in two parts. One was the logistics business, and one was the hyperlocal consumer business as we know it. So when we first saw this company, we'd seen it in its earlier avatar and super comfortable. It was in a segment and it was a model that was working out very, very well for them. And then this came along. What helped us in that situation was twofold. One is our relationship with the management itself. Even through the process when they were deliberating this mammoth decision, right? What do we do? We had zero doubts about transparency or intent. And that's when I said that you can't have a nervous lender on your back when you're going through trouble. And how do you mitigate that? By solidifying that relationship 12 months before you're at the cliff, not in a bridge situation, because we don't know each other. We don't know what the founder is thinking or what to believe. And that's why it's important to spend that 12 odd months along with the company, understand how things function so that we can face that time together pretty well. And the last thing that helped us, of course, was our good relationships with the investors around the table. So they've raised money from some of the most marquee VC investors in the country. And yeah. So this one particularly, the focus changed. So their capital requirements changed, and that loan is closed now. No, the company I mean repaid our money back. So they didn't require that sort of capital, right? I mean, yeah, if you remember the situation in which they had shut down, if you were tracking logistics, they had raised a really large round. And like I said, they did it from a position of strength when they could manage what messaging to give the market, when they could manage stakeholders like us so that we did not threaten the future of the business, and they could manage their investor expectations as well. So this was a very conscious decision which we were a central part of as well. Any other questions on venture debt itself? So a mix of things that we've touched upon: business model, of course, strength of business model, future of business model as we see, how much equity have you raised, who are your investor partners, and the management strength essentially. So it doesn't worry us if a business is only 8 months old or does not have say enough of a track record or enough companies as clients or any of that, but traction needs to be there, because traction is what has, I'm assuming, gotten your investor interested. And those are some things that we will revisit when we look at that. No reason. I mean, we have enough companies in India building for India, selling in India. I mean, the consumers are here. It's a huge market for businesses to thrive. There's no reason for companies to have a global leg to it. In fact, only a handful of companies in our business also would have that already. Also, it's easier for companies to go global after a certain point. So that's never a hindrance. Oh, so I didn't mention that. Sorry. So we are actually also present. So earlier, when we were SPB, we had a mothership out in the US, and we could be good feeders for the India-US corridor for companies looking in that direction. After 2015, we've been focused more on the Southeast Asia market. So we also have an office in Singapore and a team there that locally scans that market for venture debt as well. And between India and Singapore and Southeast Asia, we're able to put together global cross-border structures as well for such business.
Oh, sorry. I was just saying that we haven't touched a lot on the cross-border or ECB type of funding, external cross-border kind of funding, because that's not generally something relevant for most early stage startups. But that's something our platform is well positioned to do as well. So, like for example, we can go all the way up to, let's say, 10 million or $8 million in India, but we can do up like 20, $30 million from offshore. But it's a rare thing given this market, and it is, so we don't want to, it's not something that's immediately pertinent for most people. So, but happy to answer any, insofar as we know anything about it, we can talk about. Yeah. No, so
Our team is all of 11 people, with 9 people on the deal side. So Vivek and I are the team, and there are sort of senior managers who look at transactions as well. Between us, we do everything.